Well, welcome to the Broadcast PR Business Studio Debate on Emotional Finance. And in the studio, I've got Professor Mark Fenton-O'Creevy from the Open University. And first of all, Mark, I just wanted to ask you, are emotions really important in trading? Do they really matter?
Do you know, psychologists used to study emotions over here and thinking over here as if they were two completely different things. I think some of us suspected this anyway, but neuroscience over the last couple of decades has been showing us that emotions and thinking are completely intertwined all the time. So you actually can't take the emotions out of any kind of thinking, never mind trading. And one of the things that we found, I've been researching traders and what they do over the last, since the mid-90s. And one of the things that has become very clear to me over that time is that trading is an intensely emotional business, that people who trade, their emotions affect their trading and their trading affects their emotions. How they think about their trading is completely tied up with their emotions. More experienced traders, expert traders, get much better at managing their emotions, but they never go away.
Tell me about that first instance where your interest was sparked off by observing the trading floor.
Well, back in the 90s, we studied traders in about 120 traders in 4 City of London investment banks. And we really started off with a study of risk-taking behaviour. People take risks in investment banks, really interesting place to study risk-taking. And we didn't start off asking lots about emotions, but actually as we started interviewing traders, one of the things that we found is they talked about their emotions a lot. They talked about how emotional trading could be and the challenge of managing those emotions.
So what are the really important findings out of this research?
I think there's a number of things. First is that, as I say, emotions are there in trading. Trading is an intensely emotional business. The second is that they do affect how people trade. Of course, they're not always a bad thing. We shouldn't think they're a bad thing. Imagine that you're driving along the road and it's your route to work. It's a road you've driven many times before. You're not thinking very hard about driving, maybe talking to a passenger. And then a small child runs out in front of the car. And suddenly there's this surge of emotion, fear, adrenaline kicks in, and all of your attention is focused on that one thing, how to avoid hitting that child. And suddenly it seems like you've got more time, that things are happening more slowly because you've got all of those cognitive resources devoted to that task. Similarly in trading, people, some of the traders trading through the recent financial crash described to me feeling quite a lot of fear as they saw the levels of volatility in the market. But that fear was really important to make them pay attention to what was going on and what were the potential risks. So emotions can give you important information, but they can seriously mislead you as well. And certainly one of the things that we know is that certainly novice traders, people who are very early in their development as traders, typically find that as soon as they put anything at risk, that their very carefully planned strategies go out of the window because their emotions just blow them off course.
David Jones, Chief Strategist at IG Index. Can I turn to you now? Because my thoughts would be that if you're going to make the most amazing amount of money, your blood needs to be up, your heart needs to be thumping, and you really need to be very excited. But clearly this isn't true.
No, I would completely disagree with you there. You're right, it isn't true. We need to look at the markets in a very calm, detached way, to weigh up, is this really an opportunity, or am I getting carried away with my own belief, my own prejudices about these markets? And I think it's an often quoted cliche about trading, but it's very true. You have to have your emotions under control and be disciplined, because as we've already heard, for many people, they have these really firm, sensible plans when they start, but once you have a trade on and you have an increase in volatility, or you have the market not going in the way you thought it was going to go, I think if you start reacting in a highly agitated state, the outcome most times is not going to be positive, because you lose that ability to look at this dispassionately and think, was that really the right decision? Do I need to get out now and preserve my capital and look for other opportunities? I think if you're trading it emotionally, chances are you'll probably make the wrong decision.
Because a lot of good trading deals are based on the sort of information that you've educated yourself with over the years, the knowledge, and you need to stay cool to refer back to that in your mind.
I think that's true, but I think maybe the big thing that we do all learn over the years, I think if we're trading, is how important the emotional side is. I think the way I always like to look at it is, if you look at markets, in this day and age, we all have access to all sorts of real-time information right at our fingertips. You know, we have real-time news, real-time prices, real-time charts, but some people profit and some people don't. You know, so it's clearly not having a crystal ball as to knowing where the market's going, but managing how you interact with the market, whether you trade, whether you don't trade, whether you cut your losses quicker than somebody else. So I think that's the biggest benefit we get out of experience is the emotional understanding and the emotional side of it.
So David, for your clients, would you like to see an educational programme, some form of training that they could access to really help them in this?
I think it is really important. I think maybe the first hurdle we all have when we first start trading markets, whether we're like our clients, normal retail investors or an institutional trader, is the lack of appreciation as to how important this emotional angle is. But I think it's appreciated very quickly once you start actually doing it. I think until you start trading or investing in markets, you do think, I can boil all this down to a formula. But of course, that's clearly not the case. It's important to have a strategy, but it's understanding how your emotions can impact and maybe throw that strategy out the window. So I do think education around this is very important. And I think maybe the first bit is self-realization, that actually people accepting the big part that emotions do play.
So can I come back to you and ask you what kind of educational programme you would like to see coming out of your research?
Okay, well, we've already developed some learning approaches that can help people, but actually I think there's some quite simple things that people can do. I think the number one piece of advice actually about managing your emotions effectively is don't speculate with money you can't afford to lose, because that's one of the biggest generators of emotion. The second piece of advice, what a lot of professional traders do is they're very good at writing things down. What do I mean by that? They write down what their strategy is, and it acts as a commitment mechanism, so they're pretty clear what they mean their strategy to be. And the second thing they do is they write down any reasons for changing a strategy. So don't change their strategy without writing down their reasons for doing so. And one of the things that does is it causes you to say, well, hang on a minute, have I got a really good reason for changing my strategy, or is it just because I'm feeling frightened, or because I'm feeling greedy, or I'm feeling overexcited? So that can be really useful. Third thing, actually you can train yourself over time to manage your emotions more effectively. What doesn't work is just try and push your emotions down. You can't stop having emotions, and the more you suppress your emotions, actually the more likely they are to be having an effect on you. You can show physiologically that when actually people try and push their emotions down, the physiological effects increase actually, and certainly quite often the effects on the decision making. Reframing is often a really good way. Certainly what you'll see a lot of very experienced traders doing is say they made a big loss, for example, is they say, well, okay, so that's one trade. Actually, one trade is neither here nor there. I'm going to lose sometimes, I'm going to win sometimes. The question is, how am I doing over a longer period, over the year, over the course of my career as a trader and so on. Thirdly, it's also the case that you can help people learn to manage their emotions more effectively in these kind of situations with a whole range of techniques. One set of techniques is around mindfulness. Mindfulness actually comes out of Buddhist practice, but neuroscientists have been finding that mindfulness practice is a really interesting way of impacting your ability to manage your emotions. In cognitive behavioural therapy around phobias, they use it a lot, for example. And the core aim there with mindfulness practice is to say, actually, I notice my emotions, to become good at noticing your emotions, but not getting caught up in them, allowing them to pass. So you're starting to feel frightened, and you just notice that you're starting to feel frightened. You start to get very excited about something you've seen in the market, and you notice that you're getting very excited, rather than just getting caught up in it. So it's that slightly detached approach.
And finally, David, can I ask you about technology at the moment and technology to come? I mean, is that going to have an impact on how people continue to trade and affect their emotions?
I think if you let it, it could affect your emotions in a negative way, because in this day and age, of course, we never have to be out of touch with the markets. You know, we all have these fantastic mobile applications now. You can sit there on the train or on a night out and keep an eye on what your trades are doing. And I think one of the risks there is to have an emotional knee-jerk reaction because a market has moved maybe slightly the wrong way for you, but is still within the parameters of your overall strategy. So it's maybe putting too much weight on just a almost random move in the market. Maybe that's the downside, I think, of technology. So we should make sure that we use the technology in line with our strategy. You know, we don't need to be a slave to it. Just because you can check the market 24 hours a day doesn't mean you have to check the market 24 hours a day. You know, if you have the right parameters, you have your risk managed by using things such as stop loss orders, you don't need to be, I think, a slave to the prices. You know, so I think the technological advancement we've seen in the last 10, 15 years really has leveled the playing field, you know, from our point of view, for lots of private investors. But I think it's important to use that in the right way and have it work with you rather than you working against it.
Thank you both very much.
Thank you.
Thank you.